Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in our next guest. That's Landon Swan, co-founder of LikeFolio. Welcome back to the show, Landon.
Thank you. Great to be here.
All right, we're talking CAVA. Stock's fallen about 27% this month alone, but that was from elevated levels at this point. What kind of data do you guys have on this restaurant chain? Because I looked at the scale of, McDonald's and then Chipotle. CAVA has only got about 352 stores so far, but it seems like it's a favorite among investors over the last 12 months.
Yeah, it is a favorite. I mean, the PE ratio is really high. I mean, people are willing to pay a premium for this one. And their goal is to get up to 1,000 stores in the next 7 years or so. That's their goal by 2032. They only added 62 last year, so they need to pick up the pace a little bit. 11 stores last quarter. So, they're on their way. But I think a lot of investors are buying this for the future, right? I mean, that's a common theme. Is not how much money you made yesterday, but how much you're going to make tomorrow. But they did really well last quarter. They're plus 39% year over year on revenue. Same store sales were up 18%. And they're adding stores. So that's strong. They've got some things working for them. I mean, they're kind of the healthy fast casual restaurant. And so they're getting a bump from New Year's resolutions this time of year. So that's always nice. And the Mediterranean diet is actually favored by it's actually the most popular health diet, favored by people at 85% of positivity on that one. So, they're right in the sweet spot for that kind of the health conscious, wealthier consumer. And the stock, though, is really high, even though it has been hammered. I mean, after their last report, it was basically 145 right before the last report, and then it jumped up to 172 and sold off the same day. Really a wild ride for investors that day. And since then, it's dropped significantly, like you said, from 145 down to 98 now. So tough ride for the investors. But again, the PE ratio is still very rich. Now, when we look at how they're doing, they're operating. Their profit margin is very strong. I think that's one of the reasons that they're getting such a rich premium is their profit margin is about 26%. Now, by comparison, Chipotle is 26.7%. So they're right there with Chipotle, and Chipotle obviously has the economies of scale advantage. They've got a much larger footprint. They've got supply chain efficiency, things like that. So the assumption is that when they go from 350 stores to 1,000 stores over the next several years, they're going to be able to get those profit margins up even higher and possibly be more profitable than Chipotle on a per store basis or a per dollar basis. And the data that we've got is strong. I mean, their app usage. When you look at, first we'll talk about web visits. Their web visits are up significantly, 17% on a year-over-year basis. Right there, Steak and Shake's beating them, but the rest of them are, falling behind. App usage is actually doing even better than this. Their monthly active users are up over 140% on a year-over-year basis, and you can see very strong numbers there, a lot of growth. And even though there is some seasonality again to the health-conscious consumer, we're comparing year-over-year, and that wasn't a big bar in January last time. So this January is looking very strong. So overall, I think this is a company well-positioned for the future. It's very much priced for the future, and I think that's a little bit of the disconnect for investors is, how much should I be paying for this company right now? Because, a lot of investors are buying it based on 1,000 stores in several years, and, they're still only at 350. They've got to execute, but all signs point to them doing well in the future. And, off the heels of Shake Shack's report, their same store sales were up 4%. They have wealthier customers. It's a very similar market to CAVA. I think that's probably going to, lead to a little bit higher expectations. But in this market environment, it's tough to pay a premium for the future when you're seeing your whole portfolio go down. So I'm very interested to see how the market reacts to what I think will be pretty strong earnings. But how much of it's priced in and how much of it is, our investors going to say, I don't really care about 5 years from now. I need to worry about my portfolio now. Maybe I'm going more defensive or something like that. So it's going to be an interesting reaction on this one.
Yeah, Landon, this is the classic growth versus valuation name. And when something comes out, there was, a cautious notes on high growth food sales stocks. And this is, you compared it to some of the other fast food names, And I think it's gotta be compared and favorably to something like Chipotle because it's more healthy fast food, right? It's not Shake Shack where it's milkshakes and cheeseburgers. It's more healthy fast food. So it's a serious competitor with someone like Chipotle. And this is just, stocks don't go straight up. And letters come out on valuation, and the valuation may have gotten ahead of itself, but this company is still going to grow, still going to put up, big growth and margin numbers. And if they can hold those margins at a Chipotle-like level, 25, 26%, this is a dip that people should probably buy. But earnings tomorrow or earnings today will really set the tone for that, Landon.
Yeah, agreed. And I mean, if I'll get into the growth versus valuation. If you look at their PE ratio of 240, Chipotle is I think 45. So 5.5 times, and their goal is to get to 1,000 stores, which is 3 times as many stores as they have now. So I mean, there's a little bit of a disconnect in just assuming that they're going to be able to grow and grow and grow and fit into this, because eventually, if you have enough stores, you don't have a 3-digit PE ratio. You have a more realistic PE ratio, which, I wouldn't think I'd be calling 45 realistic on a restaurant, but that's where we're at now. So Chipotle's got a more realistic one. And when you get into the, thousands of stores, that has to come down. So a lot of growth is priced in, but you're right. They're well positioned with the higher end client who's more health conscious, and they're willing to pay a premium on their food. And so I like where they're positioned. I don't like the valuation. It's a little bit much, even though it has come off significantly. I think we just need to see them execute, and it's probably a good buy long term. But again, right now in this market environment, what are investors looking for? CAVA's got to come out today and really talk up the future if they want to have a good reaction to their earnings report.
Yeah, that forward PE over 190. So even the trailing at 240. 18% growth last year in comparable same-store sales last quarter, Landon. I think a lot of people look at this stock and look at this company and say, hey, widen out to a 10-year Chipotle chart, and that's what I want to be a part of at this point. It just seems to me that in a short period of time, so many people have piled into it that maybe it's susceptible at this point just due to the growth figures that everybody's predicting are going to continue.
Right. It's somewhat priced to perfection. It's all in the future. So this quarterly report, I think they're going to come out with good numbers. They're going to talk about how, their margins are good, their sales are growing. This is how many stores they opened up and all that. And, if you price it just based on that, it's way overpriced. But if you talk about the future and how well, how quickly they're going to get to 1,000 stores, how they're becoming more efficient, the trends are all going in their favor, then you can justify it. But again, it's supply and demand, like you talked about. It's a crowded trade. A lot of people have jumped into it, and that's why, when they came out with a great earnings report, they went from 145 to 172 to 145 all in the same day. I mean, that's the kind of overcrowded type reaction that you get. So now that they've sold off, they're down 50 points or so over the last 3 weeks. Now you're saying, okay, has the crowd gotten out? That's the question. And so we're going to have to wait and see on this one, but I'm cautiously optimistic going into the report because the stock price is down so much. But given again the market environment, I think people are going to be really, they're going to demand a lot out of these reports. They're looking for good companies to park their money in right now. Although for the more aggressive people, like they always say, when everyone's fearful, you should be greedy. This could be an opportunity to jump into this one in 5-10 years from now when they do have over 1,000 stores. You look like a genius because you got in at 98 or 99.
Oh, I would love to look like a genius in anything, Landon, at this point. All right, great stuff. Great data as always.
Thanks, guys.
All right, that's Landon Swan, co-founder of LikeFolio. Kev,